I guess what's the market missing? And I guess our concern is that the market has gotten a little bit too comfortable in that narrative, and that there are headwinds to growth that will slow the economy that might be underappreciated. The first of which is the likely slowing and frankly tapping out of the consumer. While consumers have jobs, it's clear that a reasonable cohort of the population, the weight of inflation relative to wages, is depleting those pandemic savings and is straining the capacity to spend. And we've seen that in the credit card debt that has now exceeded the 2019 highs as the consumer has re-leveraged in order to maintain lifestyle. We've seen evidence of some slowdown in consumer spending. The banks told us during this reporting season that the 10 to 11% credit and debit spend growth in the first quarter became 5 to 6% year-over-year growth in the second quarter. Not a disaster, but again, clearly a slowdown. Amex's trends this quarter proved to be somewhat more durable as its affluent customer base is feeling less of that pressure. And even Visa's results last night showed fairly resilient spending. So again, not sounding the alarm bells per se, but the incremental trends are showing some slowdown despite what have been some very favorable sentiment readings of late. But more broadly, I come back to this idea of just this delayed impact of monetary tightening on the broader economy. Again, recall that Fed funds wasn't actually in restrictive territory above 2.5% until September of last year. And given that those lags are longer, as we already discussed, the monetary tightening via higher rates is still going to slow the economy